Taking a look at the boards at this hour, stocks have been struggling for a fourth straight day on Wall Street. It's been a pretty mixed bag today. Dow Jones is up, though, a little bit of green on the board there as the Dow rises 20 points. The S&P has fallen about 7 points, and the Nasdaq is down 58 points halfway through the trading day. We're going to keep a close eye on it for you. So it seems like buying a home continues to get more and more expensive with every passing week. And this week, we saw mortgage rates jump to their highest in 22 years. Financial service company Bankrate says the average 30-year home loan jumped to 7.31%, and that is up from 7.12% last week, which is the highest since May of 2001. Jeff Ostrowski is a principal writer on home lending at Bankrate, and he joins me now live. Jeff, thank you so much for your time today. Let's go ahead and begin right here with how we got here in the first place. Give us some perspective. We have mortgage rates now over the 7% mark, but historically speaking, how high of a number is this?
Well, it's a really shocking number for everyone who's accustomed to rates below 5%. I mean, over the past decade, it was really hard to get a 30-year mortgage for more than 5%. And of course, during the pandemic, mortgage rates got below 3%. But if we look back farther, if we look back to the 80s and 90s, it was pretty routine for mortgage rates to be much higher. So mortgage rates infamously in 1981 hit 18%. And really throughout the 80s, they were in double digits. Throughout the 90s, mortgage rates in the 8 and 9% range were pretty common. So historically speaking, 7% is not all that jarring, but compared to where we've been over the past decade, it's a real jolt.
Yeah, I remember my mother telling me that she got her mortgage at 9%, and she was actually quite proud of that. It was a good number for her. Nevertheless, this is causing a lot of home buyers to sit on the sidelines. They're wondering if and when they should get in. Let's talk a little bit about how the Federal Reserve raising interest rates actually impacts a mortgage rate. What should potential buyers be doing right now, and how should they be looking at what the Fed is doing?
Yeah, so the Fed is a little bit tricky to gauge just because the Federal Reserve doesn't directly control mortgage rates, but a Fed policy does flow through to mortgage rates. So the closest proxy to the 30-year mortgage rates is the 10-year Treasury bond, and that reacts pretty closely to what the Fed's doing. But so for homeowners, or for potential homeowners, I don't know how useful it is to try to figure out what's going on in the mortgage market. Or forecasting rates. I think the more useful exercise is just figuring out how you're going to afford a home in this market. And so, one strategy that I advise for first-time buyers is don't get too hung up on a 20% down payment. A 20% down payment will get you the best overall deal on your mortgage, but the median home price now is over $400,000. A lot of first-time buyers probably don't have $80,000 just sitting around. So I would say for a potential home buyer, consider making a down payment of 5% or 10%, and don't get too hung up on the 20% down payment.
All right, so you're saying look at making a down payment of 5% or 10%, and don't get too hung up with putting 20% down. Is that your best advice right now for those wanting to get in?
Yeah. I mean, that's one piece of advice. It's just a very challenging market in terms of affordability. It's home prices are near historic highs. Mortgage rates have doubled over the past couple of years. Incomes have not kept pace with either of those. So it's just a very challenging market right now for first-time buyers. So I would say, yes, look at a lower down payment loan. Make sure you really shop around for a mortgage, because when mortgage rates are this volatile, there can be pretty wide ranges of the quote that you get in terms of a mortgage rate from different lenders, even on the same day. So make sure you compare at least 3 different offers. And then also make sure that your credit score is as high as it can possibly be, because that's the most important factor in setting your mortgage rate.
So you're saying to shop around for a mortgage. What is your best advice, and what should you be looking out for? And should you be looking at a 30-year fixed?
Yeah, a 30-year fixed for first-time buyers is going to give the most flexibility, because compared to a 15-year or a 20-year mortgage, the 30-year mortgage has a lower monthly payment, so that's going to make it more affordable. Back in the 80s, when mortgage rates were really high, adjustable rate mortgages were quite popular, but those aren't really a great option now, just because the rates on adjustable rate mortgages are not that much lower than fixed rate mortgages. So yes, for most home buyers, a 30-year fixed rate mortgage is the best option right now.
Now, one strategy, Jeff, that I've heard people talk about, those wanting to get into the market, is to refinance. Is that always the best option? People are obviously hoping that mortgage rates fall from
Well,
7%.
it just
Can you
depends.
just
I mean,
buy
it's
now and then
now that
wait?
that is a possibility. I mean, if you're ready to buy, if you want to buy, then I would say go ahead and buy. It's possible that rates will fall in the near future, and you'll be able to refinance into a better rate, but there's no guarantee of that. But yeah, certainly that is one possibility. Rates could fall, in which case it would be a good idea to refinance into a lower rate. But for the past couple of years, rates have been going straight up, so it's really hard to know when they're going to fall or if they're going to fall.
Well, what is going on here? Is it that inventory is really, really low? What is making the housing market so unaffordable? And what needs to happen? What is the solution in terms of your best advice for hopeful homeowners or home buyers, rather?
Yeah, well, I mean, unfortunately for potential buyers, there's really nothing they can do about this lack of supply that's keeping home prices high. So builders have not been building at the same pace that they used to. Really, after the Great Recession, home builders ramped down their building, and they've really focused more on the higher end of the market. So whereas throughout the 1950s through the 1990s, there were plentiful starter homes being built in new communities. That's not really an option. And then we've got this mortgage rate lock-in effect. So all those homeowners who refinanced at 3% a few years ago, they're not going anywhere. They don't want to trade in their 3% mortgage rate for a 7% mortgage rate. So that's really crimping the supply of homes for sale. And so, and at the same time, the millennial generation is a very large demographic cohort. They want to buy homes, and so there's a lot of demand for houses, and there's not much supply of houses. And so that's really what's keeping home prices high, even as mortgage rates have doubled over the past couple of years.
So do you think it's better just to rent in the meantime until some of this kind of clears up? The higher mortgage rates and such, and maybe the lack of inventory.
Yeah. I mean, if you think that mortgage rates are gonna fall to 5% next year, then yeah, you wouldn't want to buy now. But that's just such a hard thing to predict. So I would say if you're ready to buy, if you're financially prepared to buy, if you can afford a home, and if you need a home because of life circumstances, if you just had a child, for instance, then I would say go ahead and buy. You can't control the mortgage rate. You can't control the supply of homes for sale. So if you're ready, then buy, and if you're not ready, then continue renting. But I would say if you're trying to predict where mortgage rates are going to be in the future, it's very difficult. So I wouldn't base a decision about renting versus buying on where I think where I think mortgage rates are going to be in a year or two.
All right, Jeff Ostrowski from Bankrate, thank you so much for your time today. I appreciate you stopping by.
All right, thank you.